There is not a more important time in most of our lives that taking back control of your money is more important. The infinite banking concept is the process of taking back the banking functions in your life by using a policy as a vehicle to run your money through so that you can earn interest and use the money at the same time. Effectively, how you can make money twice on the exact same dollar.
At the end of the day, the policy is the least important part out of all of this. We're using this policy as a warehouse of wealth, as a vehicle that gives us uninterrupted, guaranteed, compounding, tax-free growth for the rest of our lives, no matter what else happens.
What did it take to do this? One change. It took you changing where your money goes first. Welcome back. Another week, another wealth webinar. Today is such an epic day because it's the day where so many of you learn how to take back control of your money. And we're going to show you how to take back control of your money, but we're also going to show you how to create wealth the easiest way. How many of you would love to create wealth without taking on any risk at all, right? You can just make great returns, whatever they are, 9 to 12, heck, 9 to 20%, zero risk. How many of you would love that? I bet you guys will go nuts in the comments. You would all love to hear that. But some of you are thinking, I don't know, Chris, that sounds too good to be true. You know, there's no way I can make 20% with zero risk. Well, you're wrong. And it's been taught a lot, but not in the right channels. You see, to find the information that you're about to learn in today's webinar, you would probably have to be in the right circles. You'd have to be in the circles of the wealthy individuals that have learned what they do now, but they had to learn how to unlearn what they've been taught their whole lives. Now, do you understand what I mean by that? Your whole life, and I will tell you, no matter how old you are, I'm 46, you've been taught money works a specific way. You've been taught that you go to work, you work hard, you hustle, you put in overtime, you bring home a paycheck, which is an exchange of your hours for dollars. You take that money and what do you do with it? Some of you would say, oh, I put some of it in a 401k, right? Who taught you that? Your ancestors, your parents, maybe your folks at work. But where's the rest of the money go? It goes into someone else's bank. Now, who's somebody else's bank? Well, that would be the Wells Fargo's, the Bank of America's, the key banks, the traditional banks. That's what you've been taught to do with your money. Now, just as a history lesson and just as a current lesson, when you put money in the bank, who is in control of that money? First person gets a pat on the ass. Who's in control? That's right, the bank, right? So Zena, who's a newcomer, even knew that. So Zena, just give yourself you just go like this and just give yourself a big slap on the ass. All right, so that is true. When you deposit money in somebody else's bank, you are putting the bank in control. Now, some of you are still thinking, no, Chris, I'm in control. Well, let's just fact check that because we are in a day and age where we seem to have to fact check everything. So when you put the money in the bank, now let's just say a denomination of 50,000 bucks, you put it into a traditional bank, whatever bank you want to put. You go back to that bank the next day and you try to take that 50 grand out. Multiple choice. Can you take that 50,000 out the next day? Yes or no? No, you cannot. And even if you did find a bank that gave you all that back, would you not have to fill forms out? Would they not ask you, well, what are you using the money for? Blah, blah, blah. Absolutely. And any of you that are still on the fence saying, I don't know, go try it. Put 50 grand in the bank and go back the next day and try to take the 50 grand out. And you'll see what I'm telling you about. The bank will literally ask you, why are you taking the money out? What is this going to be used for? As if it's any of their freaking business, because in your mind, you're thinking, that's my money. I work for that money. I just let you hang on to it. Wrong. Read the fine print in the bank. You gave them control of that money. And by giving them control, so let's go round two with this one. I'm just trying to get you to see what's going on here, folks. When you gave up control of that money and you put it in the bank, what did the bank do with your money? That 50 grand. Did they take that money, put it in a little box with your name on it and shove it in the vault? Nope. Look to your left, look to your right. There's cubicles. In those cubicles are people. And what are they doing? Borrowing money from the bank. Whose money? Your money. This guy over here is taking out a $50,000 loan to buy an SUV. Your money being lent to them. Now, final part to that question. If the bank pays you 1 to 3%, how much are they charging on that car loan? I just was at the dealership yesterday with my mom. Her lease is due and she's getting a new car. She's got enough money in her policy to use the money in her policy to buy a car, but my mom, and you'd have to understand, and those of you that have moms, sometimes they're a bit thick-headed. She's like, Chris, I know I can do that bank thing you teach, but it's just so much easier for me to just lease. I'm like, whatever, Mom, why am I here? So she leased the vehicle, and the payments on that vehicle are double where they were a year before. Now, I got her to make a commitment to me that her next vehicle after 27 months, because that's how long this lease is, we're going to use her policy, because she does have a policy with about $47,000. We're going to use that to buy the next vehicle. But anyway, you get what I'm trying to say. How much would the bank charge for a used car loan right now? It's about 8%, actually 9% if you're not a perfect credit score, 8 to 9%. So just please do the math with me. If you're making 3% from the bank, and very few banks are paying 3%. So I'm giving the bank an ultimate pat on the ass too, saying that they're actually giving you 3. If they pay you 3 and they charge you 8, who made the money? Well, you could obviously say, well, I made 3%, but they made the most amount, right? They made a spread between the 3 and the 8. And isn't that spread more than what you made? Absolutely. So who was in control? The bank was. Who made the most amount of money? The bank did. What did you do? You gave up control of your money. You let your money sit still. Why? Well, because you thought you had liquidity. Oh, I put it in the bank so that if I need it, I can take it out, but you really can't. Well, you can, but not easily. That's the sum up of everything we're going to talk about today. We're in an interesting time. And I think Stephen and I, in the years to come, we'll look back on some of these recordings and be like, holy crap, were we on point? We have been doing these shows for so long, these webinars. We've been following the patterns, the signs, people like Ray Dalio. We've been looking, and this morning it became crystal clear. I know to me, but I'm sure Stephen had a feeling like, dude, we are at the end. We are absolutely at the end. The Fed is raising rates. They've raised rates 550 basis points. That's crazy. In just over a year, it's unprecedented. It's never been done before. But why did they raise rates so fast? Well, because they printed the most amount of money they've ever printed in history, which created a little problem called inflation. They printed so much money that everybody went out and went crazy when the country opened back up and spent a lot. And they were now like, whoa, we need to pull that money back. And they are. But it took a long time to get it to work. Matter of fact, Jerome Powell recently, and actually they were just out in, where was it? Jackson Hole, right, Stephen?
Yep.
They're out in Jackson Hole for a meeting, and the whole world's watching them because they want to know, what's the Fed's action? What's the Fed going to do? Just a small little group of people, kind of just like the small little group of people that met at Jekyll Island Club back in 1913. I actually think it was 1912, but to formulate what the Fed is today. And you know what else was created in 1913? Coincidentally, the IRS tax code. That's right. We weren't taxed prior to that. We didn't have income tax prior to 1913. And you know what? Things were pretty freaking good. We had a surplus. We didn't have a deficit back then. But anyway, we can't go back in time. I'm trying to sit there and say that these couple individuals, the central bankers, are literally puppeteering what's happening right now. And for the first time since they started raising rates, the cracks in the foundation are absolutely showing. Just today, if any of you have been paying attention, new job creations, the jobs numbers, we'll just call it that, came out. Okay, ADP reported them. 177,000 new jobs were created. What were they estimating? 200,000. It's the first time jobs are going the wrong direction. So there's less jobs than they were anticipating. But not only that, this is one of the first times GDP growth has now come in slowing down. And on top of that, the inverted yield curve and all the other stuff. So what is happening? We are now literally at the top of the roller coaster. We can see where the roller coaster is going to go. And that's that part where you're like, oh shit, this is going to be you're either saying this is going to be a fun ride down. You've been on a roller coaster, right? Or you're like, oh my God. And you grab the person next to you, hopefully not in the wrong place. And then some of you, when the show actually starts and the roller coaster actually goes down, some of you throw up, some of you close your eyes. Too many of you close your eyes. And some of you just got your eyes open and a big grin. And you know who those people are? Look in the mirror. It's you. It's those of you that have already begun the process of taking back control of your money. Why are you smiling on that roller coaster ride? Because you're just like, this shit's going to be fun. Like, this guy's got his eyes closed. This person over here is about to puke. And I am going to benefit from all of this. That's the way you need to think. What we're going to kind of talk about a little bit today, and I've got a really interesting scenario, one I've never done before, one literally that I just penciled out, like as we were doing this on this like extra piece of paper. This is what you're going to learn today. This is how complicated and how difficult this is. It was literally done 2 minutes while you guys were watching that YouTube video. And all I did is I went over and I just happened to grab one of my life insurance statements. This is my oldest, one of my oldest. I have one older, but this is one of my oldest life insurance policies. I started this stupid whole life policy in 2008, June 1st of 2008, when I was a financial advisor. Anything like, remember 2008? Wasn't that like the Great Recession? Yeah, the Great Recession kicked in a little bit after, but I started this policy right before the Great Recession. Do you know what this policy is? It's a whole life policy. The one Dave Ramsey says you don't ever want to do. It just pays the advisor a big commission. They suck. They're a terrible place. Well, when we're done today, I want you to make a very firm decision. Is Dave Ramsey right, or is what we teach right? And basically, let's just keep it to the product. And we don't teach a product. We teach a process called the infinite banking concept. But we do use a product, a stupid whole life policy like this, piece of paper I have here. We use a whole life policy to fund the infinite banking concept, to become our own bank, to create our own private banking system, effectively to become our own bank, BYOB, right? So this is just a regular, off-the-shelf, whole life policy that, as I normally would say your broke-ass brother-in-law sold you. But back then, your broke-ass brother-in-law didn't sell it to you. Chris Naugle sold it to you because that's what I was told to do when I was an advisor. This is not a policy that we designed today. Not even close. I mean, we would never design a policy like this. It's just a regular whole life. Why did I buy it? I don't know. I probably needed another policy to hit some qualification for some trip, or I have no idea why I bought it. But I bought this stupid whole life policy. And in a little bit in this show, after we kind of explain the infinite banking concept in the simplest way, and then we're going to talk about this policy, but we're going to talk about this policy not just as a policy, because listen, the one thing I want to be crystal clear about for every one of you on here, if you're on here thinking that the policy that we're going to build for you, which is specially designed compared to this one, if you think that like we're going to create this magical policy that's going to set you free and create wealth, you are absolutely wrong, and you are in the wrong place. It is not the policy that's going to set you free. All I want you to think about is the policy is like an airplane, okay? So real quick, all I want to do is I want you all, you've all been on airplanes. So I just had some pilots here, and they're on our Money Multiplier team, 2 pilots, special ops guys. They're awesome. We spent the day together. They both fly commercial airplanes. So, we were talking a little bit about kind of what they do, but I'm just going to draw a commercial airliner, and you guys have all been on them before. So like, it should be no surprise that when you fly in an airplane, there's a couple things that happen. When you take off, the pilot comes on when you reach altitude and says, all right, so you either have a headwind or you have a tailwind. Everybody understands that, right? So tailwind means the wind is pushing the plane. Headwind means the wind is pushing to the thing. Now, the funny thing about an airplane is whether you're going east to west or west to east, you're going to have one of the two because of the jet stream. So sometimes when you fly, I believe it's from east to west coast, the plane is always going to have a headwind, sometimes more, sometimes less. So simple mathematics would tell you if you have an airplane that's going 500 miles per hour, I'm just going to use miles per hour, not knots, and you have a 300 mile an hour headwind, how fast is your ground speed on the plane? Stephen, if your plane is going 500 miles an hour in the air, but you have a 300 mile an hour headwind, what is your actual, like how fast, if you were on the ground, is that plane moving ground speed? 200 miles an hour.
Oh,
yeah.
200.
All right. So it's simple, right? If you're going 500, but you got a wind pushing 300 miles an hour at you, you're going 200 miles an hour. Great. Now, we know that that is not avoidable in a plane. It's just not. Because if the plane goes from east to west, it has to go from west to east. And when it goes from west to east, what does the plane have? Most of the time, it has a tailwind. So now, Brian, I think you can get this one, and Teresa and Helen and Benny and everybody else. But now let's switch it up. You are flying, and the pilot comes on and says, how's everybody doing today? We have a nice little tailwind going on the plane, 300 miles an hour. They wouldn't tell you how much. We have a 300 mile an hour tailwind, so we're going to arrive in New York City early today by about 30 minutes. Just wanted to let you know the good news. So your plane is going 500 miles an hour because the plane can't go any faster. You have a 300 mile an hour tailwind. How fast is your ground speed on your plane? 700, right? 800. I almost screwed up. Your plane is going 800 miles an hour. Let me ask you, how much harder did the plane have to work to go 300 miles an hour faster? Didn't have to work any faster. Actually, it's probably more efficient doing that, but let's just assume all things considered. The plane didn't have to burn any more fuel. The pilot didn't have to try to push the throttle anymore. And the plane is going that much faster. Everybody understands that that's listening, correct? Can I get a yes if everyone understands a headwind and a tailwind? Perfect. Then you understand exactly what we do. It's that simple. All we're going to do, folks, is we are going to put your savings, the money that you save today, and I don't know where you save money. Some of you are putting way too much money in a 401k. I have this discussion almost weekly. Stephen, I know you do too, and all of our money mentors have this discussion, and it makes us sick, but too many people are putting too much money in 401ks. Put in your 401k only up to the match. Anything else, change where that money goes first. Then some of you are actually, believe it or not, some of you are actually saving money in a bank account. I'm not going to call any of you out, but I know who you are. Some of you anyway. You are literally consciously saving money in a bank account, and you are super excited right now if you can get 3 or 4% in that bank account. Okay, I know what you're doing. So all we're trying to do here is we're trying to eliminate headwinds. So what are headwinds? Headwinds in the money space are taxes. Okay, headwinds can be inflation, the reduction of the value of your money. Headwinds can be fees and expenses inside of a 401k. So these are just some of the common headwinds, and there's way more, but I'm just trying to kind of give you, but taxes are a big one. And then also drawdown effect is another headwind. So drawdown effect is when you lose money in your investment account, you have to make more money just to get back what you lost. It's just simple mathematics. And another thing that could be a headwind is if you take a withdrawal from your bank for a period of like 5 months to buy something, that money that you took out of the bank no longer works for you. So that's a headwind. So in the financial world of how you save money, the smartest and easiest thing for us to do is just to eliminate any headwinds you have. We want to eliminate taxes. We want to reduce fees and eliminate as many of them as we can. We want to make sure you have the ability to access your money, but we want your money to still work for you. We want it still earning interest and dividends when you're using that money. I know a lot of people don't even believe that's possible, but to do all of this and to put a perpetual tailwind behind your money, like this would be the same as every plane that flies. If the pilot could just fly in a tailwind, that would be a great place. You'd all arrive early. Okay, well, with your money, when we change where your money goes first, we are adding a tailwind. The tailwind goes by the name of compound interest. Okay, we all know that, but we're going to add uninterrupted, okay, because we're not going to interrupt that compound interest. How about tax-free? How about retirement? You all love tax-free, the idea of being able to do tax-free retirement, right? Well, let's say all the money that you make inside the vehicle where your money is, it always grows tax-free. I mean, all of you probably would put money in a Roth IRA because it's tax-free if you could. Many of you can't. You make too much money. Some of you are putting money into a Roth. I talked to somebody last night. They're maxing a Roth out for them and their wife. Why? Well, because it's tax-free. But they can only put $7,500 each in because they're over 50. So with catch-up, that's it, $7,500. So imagine if all we had to do is change one thing, and that is where your money went first, and now all of a sudden, all your money has a perpetual tailwind behind it, just like that airplane. Does that make sense to everybody? Put yes. It takes one change of where your money goes first, gives you a perpetual tailwind, not just this year, not just this month, not just when the Fed is raising interest rates, for the rest of your life. Fair enough? And then this place where we put our money, the day you die, all of the money and then a leveraging point up goes to your beneficiaries, whoever you want them to be, tax-free. How freaking cool, right? You save up 100 grand, you die, your family gets $1 million. Well, that doesn't suck. Oh, tax-free. Sorry. That doesn't suck, but I'm not dying today. So Chris, tell me about the stuff I get when I'm living. Great. I already did. Grows tax-free. Grows with a uninterrupted compound interest. Guaranteed interest. Come on, how many of you want this vehicle? If I haven't told you what this vehicle is, but like everything I'm just describing, everybody wants this. This is the American dream. Why didn't my advisor tell me this existed? Well, they did. You know what this one change is? It's a stupid whole life policy. That's right. It's a stupid whole life policy. I just did a video, folks, and I've done other videos. But this one kind of woke me up. You know, with ChatGPT, how many of you use ChatGPT? Any of you use that? I am scared to death of AI, but ChatGPT can be interesting. So my videographer asked ChatGPT to give him a list of all the successful, famous people that have used whole life in their business. And you know how many people do you think the ChatGPT list came up with? Anyone guess? And these are just famous people. 75. What's up, Dexter? Oh, I don't know what number that is. 10. It was over 100, folks. Over 100. So I did a video and I just picked 10 of them, or 9 of them, or 10 of them, because I just only have 12 minutes in a video. And I went through all these families that used whole life, and I couldn't believe some of the names. They're names I've never talked about. They're names I didn't even know use this. They were people that have used this in their business. And you know what the funniest part about it was? A bunch of them were Wall Street folks, investment bankers, and bankers. So hold on a second, wait a second. Why in the hell would a banker use a whole life policy when they run a bank, when they own a bank? Why would the Morgans and the Stanleys use whole life insurance when they own a bank? I'll let you guys figure that out. And why would an investment banker use a whole life policy when they could invest in the S&P 500? They can invest in stocks and commodities and derivatives. Why would they ever use a whole life policy? Well, you'll have to wait for the video to come out. But it's the exact same reason you should all be using it. And those reasons are a perpetual tailwind behind your money for the rest of your life. Tax-free, protected against judgments and liens. I love it when people try online to bash this. Oh, they're just trying to sell a whole life policy. You know what I'm going to start saying? Yeah, and you should buy one. But the one funny thing, and Stephen and my entire team will tell you, we don't ever sell whole life. And sometimes I got to be careful because like online, I'll be like, and we're never, get on a call with us and we're never going to try to sell you a whole life. And people are like, oh, well, who should I call to buy one of these? Oh, crap. I mean, we're not going to try to sell you one because you're just going to ask us to help you set one up. Do you know why you're going to ask us to help you set up a whole life policy, a specially designed whole life? Can anyone tell me why you would ever ask me or Stephen to set up a specially designed whole life? Why? What would be the number one reason you would beg us to help you set this up? But wouldn't it just be because it solves your problem, whatever your problem is? Wouldn't that just be a cool reason to set one of these up? I think it would be. Yeah, numbers don't lie. I love your answers, folks. It's awesome. Protect your money, common sense, preservation of principle, to solve a problem. But all of that is a problem. Everything everyone just said there is correct because every one of those things comes down to one single solitary reason you buy anything. It solves a problem. You buy a car, why? Because you need to get to work and you need to drive the kids to school and to soccer and to everything else, right? Why do you buy a cheeseburger? To solve a problem. You're freaking hungry. Why do you buy anything? To solve a problem, whatever it is. Every purchase you have ever made in your life was done to solve a problem. And nobody had to sell you anything. Well, sometimes they did, but realistically, you were in that place because you had a problem and you wanted to solve it. Now, whatever they sold you, maybe one was better than another, but at the end of the day, you buy because it solves a problem. And I want you all to know that, like, literally, I'm being sincere. Me and Stephen, this morning, when we were doing WTF, after that, we're like, what do you want to talk about on WT or on Wealth Webinar? I'm like, I don't know. I've been sick. I haven't really thought about it. And then he's like, all right, well, let's just talk about taking back control. And I'm like, cool. So like, this isn't some rehearsed thing, folks. And the reason this is not some rehearsed webinar, is the reason me and Stephen didn't have to sit down and coordinate this with the team and figure out what we're going to do and come up with fancy illustrations is because, you know what, we do this every single day in our own lives, every day. So I thought the best way for me to show this is to show you a real scenario that I am doing right now. And I'm doing this right now, and I'm doing it with a team that none of you even know exists. A team that is called D4. You'll hear a lot about D4 in either fourth quarter or first quarter of next year. It's called Done For You, D4. D4 is being created to solve a problem. Whose problem? Well, I hate to say it, but mine. I got a problem. I've been doing this so long that I've amassed a pretty good sized private banking system. Not as big as Brent Kessler's, but I'm getting there. And I got this pretty big banking system and I lend a lot of money and I pay off a lot of debt and I buy a lot of cars. And you know, you have all this activity and then all of a sudden you're like, wow, I got a lot of activity. Kind of like that video, like, whoa, I got a lot of loans out. And then it becomes a problem because I get busy and I can't track all these loans. And I kind of am starting to think, holy crap, like I need somebody to help me with this. And I'm like, wait a second, we got the mapping team and the mapping team's great, but they don't actually do it for me. So why don't we create a program that actually does it for people, that does everything for it? The bookkeeping, the tracking, structuring of the paperwork for the loans, structuring of everything else. So if I may, I'm just going to show you one that we're doing right now. It's nothing crazy. It's nothing fancy. It's not like the one I did where we bought the fancy cars or anything like that. Is it okay if I show everybody kind of what I'm doing? All right, good. It's all right here. So first and foremost, here, let me start with a question. How many of you have equity in your homes? And if you do, chances are you probably got yourself a home equity line of credit, right? And if you do, you probably maybe are using that home equity line of credit. Maybe you're lending it out. Maybe you're doing things. Well, I personally don't have a home equity line of credit on my house because it's very difficult to get a home equity line of credit on a house that you don't actually own. And what do I mean by that? Well, I don't own my house. A trust does. My family trust owns my house, but I control my house. I just don't own it. So if somebody were to sue me and be like, hey, I want Chris's mansion, go ahead and try. I don't own it. So you can't take it. I got a home equity line of credit, but it's on my mom's house. And we have used this home equity line of credit for years and years. We've lent money, we've done house flips, we've done renovations, we've done all sorts of stuff. Okay, and that home equity line of credit right now has a balance of $66,439.15. I'm not going to say anything, but a Porsche might have something to do with a little bit of those numbers, but that's not important for today's conversation. But here is the problem that I needed to solve. When I started looking at this a couple weeks ago, I started realizing that home equity line of credits, last year they were 3%. That went away. How much is your home equity line of credit, folks? How much is your home equity line of credit right now? Because you tell me yours and I'll tell you mine. 7%. That's pretty darn good. What else? How much is somebody else's line of credit? 8. Okay. Man, I'm freaking getting ripped off. Oh, Virginia. All right. So me and Virginia's got a lot in common because I looked, and the interest that this home equity line, those tricky little buggers over at the bank, they don't even tell you they're going to kick you in the ass or do something naughty to you, but they just do it. And then you find out by looking at your online banking, and you're like, wait a second, what the hell? You're charging me 9.24%? So I started doing the math. 9.24% means that every year the bank is charging me, and folks, this hasn't been very long that we've had a balance. I actually didn't really have a balance at all on this, but I used it. $6138.97. This is interest on that home equity line of credit. Folks, that is $511.58 a month. Now, that is a problem. That's a problem that needs to be solved. All right, so that's the problem. Now, this is going to be very simple for me to explain, but I want to break it down how D4 would break this thing down. And I've got a lot of numbers. The first thing that I want to do is I want to pay this home equity line of credit off. So there's a couple ways I can do it. I could take money from a bank account and pay the home equity line of credit off, right? I could. If I had 66 grand in a bank account, I could just pay that off. But how many of you actually think I'm stupid enough to have $66,000 sitting in somebody else's bank? Does anyone think like I'd be dumb enough to ever do something like that? Of course not. So if I had 66 grand, where does anyone think that money might be? In my policies, right? It wouldn't be in somebody else's bank. I sincerely do not have $66,000 in a bank account. If I added them all up, personally, I might, I don't know, I might have 10 grand, maybe 11, but that's a lot. So I don't have 66 grand in a bank account, but I do have 66 grand or more in policies. So what I want to do, and I want to do this because, we always like to show you things that you're going to always do better than. So I said, all right, what policy could I show that I could take a loan from and pay this debt off? So I went back and I said, this New York Life policy here, from when I was an advisor for New York Life and Life Securities, why don't I use that one? Because it's just a regular whole life. So there's no way any of you would ever get on the phone with me or my team to set your specially designed whole life up that you'd ever get a policy this bad. I mean, I would never, ever allow anyone on my team to just, help any of you set up a regular off-the-shelf whole life. Steven, have you ever done that?
Maybe once or twice.
Okay, so like this old policy. So let me give you the specifics. I kind of already told them to you, but it started in 2008. So that means it's now 15 years old. I got to look at my notes. So it's 15 years old. So that's pretty old, right? 15 years. Now, let me get you some of the numbers. So when I set this up, I didn't have a lot of money, so I set it up with a premium of $389.06. Now, how did I ever come up with that premium of $389.06 a month? I didn't. The insurance company did, which is the complete opposite of what we do today. We always start with how much money you want to put into your premium deposits. But back then, I bought a death benefit, and I can't remember what the death benefit was, but let's just say it was $200,000. Okay, and I think that is where it was. I said, I'm going to do a $200,000 death benefit. What's that going to cost me? $389.06. You guys have all done this before. This is the regular way a life insurance agent would sell you a policy, right? They'd say, well, how much death benefit do you want? Or here's how much death benefit you need. Here's what the cost is. Backwards from how we do it today. But again, I did this in 08. I knew nothing about infinite banking. Let's just go through the numbers in this policy because this is just a regular whole life. So if I fast forward till today, 15 years, the total amount of premiums that I've put into this, I did all the math beforehand, is $70,030. That's my total premium that I've put into this policy, okay? Today, as of, well, actually, this is old. This is as of June, okay? So it's a little bit more than this. But as of June, my policy's cash value is $81,976.38, which means for 15 years in a regular whole life, I have made $11,946 in profit, guaranteed interest plus dividends, okay? And that works out to be, since inception, a 17% cumulative return, or if you break it down per year, which is not the right way, I made about 1.1%, 1.1% a year, right? Nothing to write home about. I mean, all of you would leave the webinar if we were sitting here telling you, hey, we'll set you up a policy that'll make 1.1%. But you know what's really cool about this? It's not about the policy. You're never going to buy a whole life because of what you're making on the whole life. You're going to buy a whole life because the whole life is the only vehicle that ever allows you to have money in it, earning an interest rate. This is a regular whole life. Ours that we do now are probably going to have an internal rate of return of around 3 to 4%, not 1, but this is 1. But I make 1% per year, and I get to use the money every year without interrupting that 1%. Now, how many of you know a place where you can put, I don't know, $70,000, earn, in this scenario, we'll just use the lowest ever, 1.1%. But if any time I wanted to take any of this $81,000 out, I would still make the same return, even though I took that money out. How many of you want to do that? But see, that's not how we do the math. I was trying to trick all of you because some of you are like, I would never do that. I would never do a policy if that's all I made. Well, that's not how much you make. Because now what we're going to do is we're going to show you what we actually teach, which is not how to buy a stupid policy. It is how to actually build wealth by using a policy as a vehicle to run your money through so that you can earn interest and use the money at the same time. Effectively, how you can make money twice on the exact same dollar.
Breaking news, this just in. Are you sick of having your money lying around not doing anything? Well, we've got the solution for you. PrivateMoneyClub.com. Back to you, Chris.
So now let's get into the fun stuff. And I'm happy to share this with anybody. And I don't know if you guys can see the numbers. I mean, I'm being transparent. So there's 2 numbers on here. First off, it shows me that in the past year, my 2023 dividend was $1,400. So here, let's write this down. So my dividend, and does everybody know that the dividends in a whole life policy are tax-free? Do you know why? Well, Dave Ramsey told you why. Dave Ramsey goes on and bashes whole life all the time. All those dividends, they're not even dividends. They're just giving you part of your premium back. It's a return of your premiums not used. Precisely, Dave. And if you ever, Dave, studied the IRS code, Dave, you would have understood that, Dave, a return of premium, Dave, is not a taxable event, Dave. Those dividends you get on those stocks, Dave, is a taxable event. So the insurance companies are way smarter than you, Dave. Anyway, enough, Dave. So the dividend for 2023 on this policy was $1,472.98. But wait, there's more. That's just the dividend. See, then I have this other thing. During the past year, your base plan guaranteed cash value, because I have no PUAs in this, it's just base. My guaranteed, that should be like, well, guaranteed plan cash value increased $6,142.50. So let's just do the math. when we talk about these policies, we're usually using hypotheticals. Sometimes we're using actual examples, but I'm using actually my policy. So when I add the dividend and the interest up, that means I made, let's see, where am I? $7,615.48. That's how much money I made this year. You know what the cool part about that is? Next year, I am guaranteed to make more than that. The year after, I am guaranteed to make more than that. The year after, I am guaranteed to make more than that. Whether the 80-some thousand bucks is in there or not, isn't that cool? But so let's just do some math here, because this is the real return. I made $7,615.48 in 2023 on this policy. How much money did I put in for premiums? Because we got to subtract the amount I put in for premiums. $4,668.72. Okay, this is my premium that I put in. So that can't really be counted toward this. So we got to subtract that. So if I subtract that, that means my true net growth on this policy, that's my net gain. And now let me clarify net gain. Net gain means after the cost of insurance. Net gain means after the cost of the policy service fee, which is 50 bucks, net of all costs. So, but let me also clarify something. I made $2,976 this year net. And if I die tomorrow, my family gets $283,140. But wait a second, Chris, you got your numbers wrong. A second ago, you said it was only $200,000. That was then. This is now. As your cash value and your policies grow, so does your death benefit. I have grown my death benefit by almost the exact amount, actually more than what my cash value has gone up. Because remember, with the day I started the policy, I had zero cash value. I now have $81,976 in cash value. And because I have $81,976 in cash value, that also means my death benefit has gone up $83,140. Did you see how that works? So if I die, my family gets $283,000. That keeps up with inflation, doesn't it? Remember I said one of the headwinds, inflation. So that keeps up with inflation. But this is the number you guys are going to want to see. Because I know none of you were really pumped about that 1.1%, were you? And I didn't even do the math right, but I'm just trying to get you riled up and get you all excited about how terrible that whole life is. Because there's someone on here I know that's like, oh, see, I told you those whole lives aren't very good. We made $2,946. If I divide 2,946 into the amount of premium I paid, can anyone tell me what kind of a return that gives me? Like, what is that called? I take this year's gain and I divide it into this year's premium deposit. Can anyone tell me? It's called a cash on cash return. Now, if any of you have done the math, you would have come up with this number, 63%. This year, in that stupid old whole life, my cash on cash return was 63%. Oh yeah, but Chris, if you take a loan from that policy to pay that home equity line of credit off, they're going to charge you interest. Yep, they sure are, 5%. If any of you made 63% and you had to give the insurance company 5%, would you be upset? Stephen, I know that's a lot to ask, but would you be mad at the insurance company for taking 5% back for letting you use all that money? But you see, even if I took all this money out, which we're going to right now, so let's come back over here. Now that you understand the math, that's my cash value. So how many of you think I should take a loan from my cash value to pay off this line of credit? Say yes if you think I should do that. Okay, and if I do, the only downside is the insurance company is going to use my $81,000 as collateral for that $66,000 loan. And you know what else they're going to do? They're going to reduce my death benefit by 60, what was the number? 66 and change? 66,439. So, whoa, 66,439. They're going to reduce my death benefit. Why? Because they're giving me a loan against my death benefit. And they're going to charge me 5% on that. 5 is going to come from my year-over-year return, because I might only need this for a couple of years, but next year my return's more. So do I care? Nope. So I did the math for you here, and this is pretty eye-opening. This is actually really stinking eye-opening. So remember, the home equity line of credit, actually, you know what, if you don't mind, I'm just going to keep this super simple. You all know the numbers down here. Okay, this is all of it here. So let me just get rid of all this. This is all being recorded and will be on the YouTube if you want to come back and dissect all the numbers. But we know that the HELOCs cost me $511. So now I'm going to do this kind of goofy, and I'm going to actually do the math with you right now, because the way I'm actually going to do it is a little different than I'm going to teach, but I want to keep this super freaking simple. So if we know that the loan, let me just double check. I want to make sure that the loan interest rate is 5%, because it might be 5.5. Let's just go with the high number. I think it's 5, but let's go with 5.5, right? So if I'm going to take $66,439.15 a loan from my policy, it's going to cost me 5.5%. So let's do the math on that. So 66,439.15 times 0.055. That would mean that the insurance company, them bastards, are going to charge me $3,654.15 divided by 12, because we're going to do this monthly, is $304.51 a month. So can anyone see the math that I'm going to do next? Right over here. I'm giving the bank $511.58 in interest every single month. If I do this transaction and I pay off the bank's home equity line of credit, and then I have to pay the insurance company $304.51 a month in interest, what do I make? Minus $511.58. I make $207.07. That's my spread. But you see, that's not all I made. Can anyone remember from the prior screen, how much money did I actually make? Because we're not here to talk about doing this. We're here to talk about how you make money twice. So how much money did I actually make? I make 207 here, but how much did I make on the policy's cash value? Anyone remember? This year it was 63%. But we got to give the insurance company back. Now I up the ante, so 63 minus 5.5. I made 57.5% on my cash value. And why will that not change? Because remember, when I took this loan from my policy, I didn't take my money. 81,000 is in there earning interest and dividends, just like it was before. All they did is give me my death benefit. And I pay this off and I make $207, plus I make all the interest and dividends. I no longer owe the bank. And then what I do is I continue, because if I was used to paying Key Bank, this is where it gets really fun. How much am I required to pay back to the insurance company? Really nothing, but how much should I pay back? Well, I should at least pay the insurance company the policy loan interest, right? I should at least give the insurance company, well, I'm going to have to give the insurance company the 304. But what if I just paid the insurance company back the 511.58? Because isn't that the amount that I was given to Key Bank? I was used to paying Key Bank every month. Matter of fact, I don't even notice that money going away until I look at it. Many of you are the same. You don't even look at your account, but yet your bills and your debts are coming out of your account and you're not even paying attention. That's what the D4 team will do, is help you pay attention by doing it for you. So I'm just going to pay $511.58, the amount I used to give to Key Bank. I'm going to pay that back to my policy. So now I'm covering the loan interest, plus I'm paying $207 every single month. So $207.07 every single month times 12. So that's $2,484.84 is going to principal every single year. So when I pay $2,484 back to the insurance company, I'm paying the loan down, which means I'm being charged less interest on the loan every single month I pay it down, which means I'm actually making more money than I even showed you, because every year and every month I'm working off a declining loan balance. But remember, I'm still earning interest on all of my cash value. Is this sinking in yet? I know I gave you a lot of numbers, but did that strike a nerve to anyone? Because it should have. Because I literally just showed you something that I learned way back when, that I have never stopped applying in my life. And I've gone out and taught thousands and thousands of people, many of you being the ones I'm teaching. And what I'm teaching you is not very complicated. And I say this all the time. What did it take to do this? One change. It took you changing where your money goes first. Oh, and yes, you got to start one of those stupid whole lives, but just pretend you don't know what that whole life is. Just don't even call it a whole life. Call it, I'm going to start my own private banking system. And I'm going to put my money in this magic vehicle that's going to pay me guaranteed interest, put a perpetual tailwind behind my money for the rest of my life. And then I'm going to apply one step, and I'm just going to pay myself back what I used to pay the bank. So if I pay this HELOC off, I'm going to pay myself back the same amount I used to pay them. That's not complicated either. And if this wasn't a HELOC and this was a car loan, so let's just take HELOC out and let's just say this was a car loan you paid off. Do the numbers change? No, it's all the same thing. If it wasn't a car loan and it was a mortgage, does that change anything? No. See, this right here, this little box that I keep changing, this is just your opportunity. This is whatever the problem is that you want to solve. You want more income? I was on the phone last night with a client and I was going through it. He's one of the few clients I've ever met with where I actually had to tell him, you're shooting too low. Your goals are too low. Like you're saving too much money. Because if your goal is to retire with this much and here's all the things you want to do, you're going to, unfortunately, I got bad news for you. You're going to have too much money. So we got to up the ante and we got to figure out what you're going to do. Because if this is your simple life and this is what you need to support it, well, then you're going to have to find some people to donate some money to that really, really change your life. And he loved it. But all I'm trying to say is like, this is the problem. What problem do we want to solve today? Well, if you want to build wealth, the fastest way is through your debts and expenses. We got to get rid of the credit cards first because those are hurting you bad. So credit cards, remember I did this with 9.24. We're talking about 20+% right now. Like, remember I said you can earn a guaranteed 20% on your money. That's how you pay off your credit cards. Here, this example that I just did, I made a guaranteed 9.24%. Why? Because I was given 9.24% away to the bank. Now I'm going to pay 9.24 back to myself. This isn't hard, folks. It's so simple. And if it's not 9.24, if it's 20%, great. I even met with a client 2 days ago. I talked to him, and they had car loans. And they didn't know a lot on the car loans, and their car loans were only like 2%. But I did the math. The amount of the payment, the cash flow that they'd bring back worked out in their favor. And that it was a hard thing for them to swallow because they're like, well, wait a second, the loan on the policy is 5 and the car loan's only 2.64. Why would I ever do that? I just ran the math on the payments and I said, this is why. Look at how much extra money you're going to keep. Oh my God, I never thought about it that way. Yeah, because you're not taught to think about it that way. You're not taught to really understand how mathematics works. And from the surface, most people just do this minus this or this plus this. They don't actually factor in the volume of interest and they don't actually factor in the volume of cash flow. So there's a lot of moving parts, but again, let's not get too deep into the rabbit hole here. Let's just focus on the surface level. Everybody understands how I did this, right? These are real numbers. I didn't make any of this up. These are real numbers from a stupid old regular whole life, not even one that we designed. And it's because some of you are thinking, yeah, but your whole life's 15 years old. Yeah, well, the ones we designed today, it would do more than this in 5 years. Well, maybe 10, but maybe not even, maybe 7, depends. But it would be close.
Yeah, just had a lot of good questions coming in. I've been answering in the Q&A. And so anybody that's looking to get one of these policies started, or if you have any questions, anything like that, you know, our team is here to work with you and chat with you about your situation. So I'll put the link in the chat box. Just schedule a call with us and we'll hop on and talk through and see if we can help you get started with all this stuff. And keep the questions coming. They're really good right now.
Yeah, I mean, keep the questions coming in the Q&A, folks. But the thing I want you to understand is the one common denominator of what I showed you today is that whatever you do, yours is going to be way better than what I just showed you. Because your policy is going to be designed for the infinite banking concept. It's not going to just be an old whole life. But I just thought, listen, if I'm going to teach this to folks today and I'm going to tell them how to get back control of their money, why don't I just give them the worst freaking example of a policy that I ever could? This might not be the worst. You know what the worst would be that would never work would be an IUL. So just to be clear, because we do have some newcomers, the only type of life insurance that will work for what you just saw, and I don't care what anyone tells you, I will literally go to bat. I will get in a fist fight for you over this. I will do anything you want. I've done debates, and an IUL, an index universal life, cannot and will not do what I just showed you. It just is not designed to do that. They will tell you that it does. They will tell you that it can, and it's almost always because they want the commission, because IULs pay a high commission. This regular whole life, anyone here, let's just do this while the questions come in. And Stephen, just stop me if there's some questions coming in. But you know, people are always like, well, how much do you make? Okay, well, let's just hit that because this is a really good example. So if I sold you this policy that I just gave you an example back in 2008, the premium was $4,668.72. That was the premium. So how much did I make when I sold whole life? Regular off-the-shelf whole life, I would get 55%. And every single year after the first year, I got a 7% renewal, okay? That's the math. So let's do the math on that. So on this particular policy, 4,668.72 times 0.55. So I got paid $2,567.79. That would have been my commission. Now, since I did this on my own life, back when I was at New York Life, I got a reduced commission, but let's just assume that's what I made. Plus, every year I get 7% of that as a renewal for the next, I can't remember if it was 5 or 7 years. So every year for like 5 to 7 years, I'd get paid another $179, something like that. This is the renewal. This is the commission. So most of you would say, well, that's not too bad. Yeah, not too bad for the agent, because in that old whole life, what you don't know is the first year I had 0 cash value. The second year I had 0 cash value. The third year I had close to 0. So I lost 3 years of my money working for me outside the policy. It worked for me in the policy, but not outside. So the way we design these is we would never design these this way. Matter of fact, how we would design these is, here, let's just remember that number, 2579. We would take this total premium. Let's just keep things the same, okay? Your number would never look like that. It would always be a number you tell us. It'd be 5 grand, 10 grand, whatever you decide you want to put in. Let's just use 4,668, 4,668. We would take a large portion of that. Let's just say 75% of that amount, and we would put that into what's called a PUA rider, which would reduce your death benefit, but that means $3,501 of your 4,668 would go to a paid up additions rider, of which we make about 2%. Okay, times 0.02, $70. Woo! Steven, dude, Starbucks on me, buddy. Okay, so we got $70. Now, the difference, so now we take 4,668.72, subtract the 3,501, and that means the 25% goes to the base. Just so you all know, when I say base, that old whole life policy, 100% of the premium went into base, which is why the commission was $2,567. This goes into base, so that's $1,167. I'm cutting out the change. And we get paid, let's just do the same, 55%. Okay, we'll just keep it all the same. So we get paid 55% on the base. So that's 642. We'll just keep it at that. I'm running out of room. Plus 70.02. So $702.26. So 700, same policy, except for one is designed for IBC, one is not. We make $712.26. Then we do get a renewal. It's nice. Okay, $49 a year. So we get $49 every year for, what is our renewal? 7 years? We'll call it 7 years. It's 5 or 7. I don't keep track.
No idea.
So see the difference in these two numbers? The commission that I used to make, the commission I would make now on building a policy. Do you know who gets that? Do you know why you have access to your cash value immediately in the first 30 days from opening your policy? It's because this amount of money is what we didn't make so that you would have access to that money. What we don't make in commission basically stays in your cash value. So it would be this plus whatever we put in, almost all of what we put into the paid up additions, about 92% of the 35. So you can see if we put 46 in, we'd have access to about 90% of the 3501 plus roughly about that much that we gave up in commission. Now, do you see how this works? There's no secret. Somebody's got to give so somebody else gets. Somebody's got to give so somebody else gets. Let's hit some questions, Stephen.
Yeah, just letting people know if they want one of these banking policies, give you a shout. But if you want a whole life policy standard, call me. I'm your man. I want that commission.
Don't call me. That sounds too boring. I hate to say it. For the first time, I'll say this, but that's below my pay grade. And I don't mean that in a bad way. I just mean I want to help build policies that work for the infinite banking concept. I don't know why anyone would want a regular whole life when they both do the same.
Yeah, I'm just joking.
I know you are. George was just asking, how do I start an IBC policy?
Yeah, I'll put the link in again. So just schedule a call with our team, and we'll walk you right through the process, answer any questions you have, talk to you about the right amount of premium to put into it, which again, the premium, we consider the funding of the policy, or better yet, the deposits that go into it. Just from a mindset standpoint, if this is your banking system and you're putting your money into a bank, you're depositing money at the bank. So if this is your banking system, we're depositing money into our policy. So even though technically it's the premium that's going in, because of the way we use it, we just want to change that mindset a little bit to consider it the funding of it, the deposits. So we can talk a little bit about what that looks like.
What's up, Deborah? So Deborah said, does it make sense to take out a HELOC to fund a whole life policy and use the cash value to pay off my credit cards and also to be a private lender and earn 10 to 15%? I mean, the answer is absolutely yes. The answer is only yes. So if you, Deborah, if you had just said to me or Steven, I want to take out a home equity line of credit and I want to use that to fund my policy, and you stop there, I would say no. I would say, no, don't do that. That makes no sense, because I would have been asking, what are we doing with it next? And then you clearly demonstrated that. You said, I want to use the cash value to pay off my credit cards. So the reason we would do that, even though by doing it that way, we lose access to your HELOC of anywhere between 10% to 15%. So the amount, if you just took the money direct from your HELOC and paid off the credit card debts, to taking money from your HELOC, putting it in the policy, and then paying off the credit cards, we lose about 10 to 15%, depending on age, health, and a couple other factors, okay? So a lot of times, like, I won't allow people to do that unless we can substantiate why we would. And you did that, because I know credit cards are going to be between 15 and 20%. So if we took your HELOC and we put it into your policy, and again, there's only certain times we do that, we put it into your policy, we take a loan out of the policy to pay off credit cards, and then we can take back and recapture 20% back into the policy. We wouldn't take all 20% back to the policy. We would figure out what the HELOC is going to charge, probably 7 to 9%, and we would send part of that 20% back to the HELOC to pay that, the remaining amount back to the policy to repay the loan. And then when we repay the loan, we could always take the money and put it back to the HELOC, or we could just take more of this. But because the spread is big enough, that makes perfect sense. Hopefully that made sense. And then the same exact thing's true is once we pay off your credit cards, we're going to have so much extra money, because let's add up all the amount of the monthly payments you make to the credit cards. Just add it up. And then figure if you could take all that money you paid to your credit cards and you can put it back toward your home equity line of credit or back toward your policy, or split it and do both, you're going to be lending really quickly. And then the same thing is true. The numbers just work. It's a mathematical equation every single time. Johnny said, if I deposit in the beginning of each month, when can you withdraw? We always say immediately in the first 30 days of your policy going into force, or immediately 30 days after you make your deposit. That's always going to be the answer. All right. Kel said, thank you for the earlier answers. My kid is under 18. Can I still do a whole life policy that can be used for IBC? Would it matter in cost numbers if I do policy versus on kids? So Cal, yeah, I mean, my policy that I did on my daughter was 6 months old when I started it. I did a $5,000 policy. So definitely will work for your kids. Matter of fact, if they're under 18, depending on how far under 18, they might not even need a medical. I think medicals, if I'm not mistaken, start at 17 or somewhere, maybe it's 16. It's policy or company by company specific. But the one thing you all must know is a lot of people ask this question: should I do a policy on my kids, or should I do a policy on myself? Well, the answer is simple. You have to do a policy on yourself. You're the breadwinner, you're the parents. The insurance company physically will not allow you to start a policy on your kids if you're not insured first, or if you're not deemed uninsurable. Why? Well, because they know you're the breadwinner, and they know that if you don't have coverage, well, why are you taking coverage out on your kids? It comes into an ethical question for them, and they won't allow you to do it. JHO said, will I be able to watch the replay? I'm just getting on, been dealing with a hurricane. I hope everything's okay with you, in your home and your family with the hurricane. I know it sounds like it's bad in certain parts of Florida, but yes, this is recorded. This will be saved and put onto my YouTube channel, which is at the Chris Naugle. So just go to YouTube, type in the Chris Naugle and subscribe. And in about a week, it'll be up on there.
How does the interest you pay yourself back not increase your capped premium deposit?
Because the interest you're paying yourself back is going back as a loan repayment, not a premium deposit. So the loan repayment, if you think about it, well, here, I kind of just drew the circle. They're two different components, and it's easier if I just illustrate it. You just draw a circle. The goal is to have your money start here, which is your premiums, which are capped based on the MEC limits, okay? So the cap is going to be the MEC 7 pay, and that's going to be built off of the amount you want to put in. So if you say, I want to put $10,000 a year into the policy, that's the most you can ever put in. You can only go down, you can't go up. So if that's your cap, how does the interest payments not affect that? So let's just say we pay off a credit card, or we loan money out, and let's just use 15%, because both could be the same. Okay, so we loan the money out at 15% or we pay off a credit card, one of the two. We take that interest and we pay that interest back to the policy as a loan repayment. All we're doing is we're just paying that loan back. Now, when we get to the point where the loan's paid back, if there's still more interest coming in, that's going to have to go to another policy. So then we start branch office number 2, branch office number 3, which is second and third policies. So that's why, because this premium deposit is different than this loan or interest that you're repaying back to the policy. They're two different numbers. Okay. One is new money coming in, one is existing money coming back. Good question.
Yeah, and when you're recapturing interest or profits, you will get to a point where that money will not fit into your policy. And so that's where that segregated account comes into play. And then as the money builds in there, that won't fit back into the policy because of the MEC limits, as that money builds, and that's when we look at adding additional policies. And that kind of goes into somebody else's question over here. And they said, is there limits on maximum deposits? If so, how many policies can you own? And that's exactly right. So when you start a policy, you decide how much you want to put into it annually. Now you can pay into it monthly, quarterly, biannual, or all up front each year, but that annual number does become the maximum amount for that policy. So you have the flexibility of putting less money in if you need to. You just can't put more money in. So once you get to the point where you want to put more money in than what that policy will hold, that's when you say, okay, it's time to open up an additional policy. And you can open up as many policies as you qualify for. So remember, each time you open one, though, you qualify medically and financially. So you really, they look at, most companies are 25% of your income, annual income is what you can put into a policy. Now, you can also take into account, however, assets and investment income and stuff like that to increase that number. And so the more assets you grow, the more policies you can get and financially qualify for. So you just keep growing them. And then from there, you could start opening up policies on other people as well. So for example, Chris and I have policies on our wife, on our child, you can open them on business partners. People go into their grandchildren sometimes. So there's also other areas also, just in case if you're maxed out or something happens with your health and you just unfortunately can't qualify any longer, we just look at using another life. So there's lots of solutions and strategies for doing that. And remember, typically when we design a policy, after that amount's going to go into it for the first 10 years, and then that amount's going to significantly drop. So what we start doing is we start strategizing to get more money in once that number drops, to make sure that, you don't have money sitting and using old banks again. We're just building our banking system, and we'll strategize with you on all that.
Great answer. Great answer.
So they said, how much money will I need to start a policy? They're $35,000 in debt. Husband is $11,000 in debt.
Yeah, I mean, the minimum, which is always the easiest thing, is just to put in 10 times your age. So add a 0 behind your age. So if you're 60, 600 a month is the minimum. So that would be the easiest way to answer that. But you can put any amount as long as you're above that minimum. Sorry, I'm trying to, this thing's touchy today. Stephen, I'm trying to put in, somebody was asking how they contact us and how do they set up a call. I was just trying to put that in again, and I'm failing miserably.
I'll do it.
Then Jim said, can I change the amount of premiums you pay? Yes, but Jim, so can you change the premium? Remember I mentioned earlier on this, if you set, and I'm just using round numbers for simple math, your number's your number, whatever you want. If you set your policy to put 10 grand in, you'll be able to reduce it by anywhere between 60 and about 75%. Okay, that'll be the reduction. So you could take 10,000 and go down to about 2,500 in most of the policies, give or take 100 or 2, but you can't ever really go higher unless we design the policy to go higher. Same thing, if we design a policy to hold $100,000, the minimum's about 25,000, 75, anywhere between 60 and 75, so % less. So between 40, to 25,000. So you can always go down, just not up.
You've mentioned these policies can be used in a company. Can you mention some benefits of doing it with employees?
Yeah, so I do this a lot. It's called COLI, company-owned life insurance. And the real reason to do this, there's lots of reasons, but let's say a company has a partner. There's 2 partners. I'll just keep it simple. There's partner A, partner B, and they want to go through and they're talking to their attorney, and the attorney says, we need to set up a buy-sell agreement. What that basically means is if partner A dies, partner B probably doesn't want to become partners with partner A's wife or significant other. Okay, so what the buy-sell does is it provides funding in the event of an unforeseen event or a buyout where the money's already in place. So to fund a buy-sell, what each partner would do, or there's lots of different ways to do it, but cross purchase or entity purchase. Let's just do an entity purchase where the entity buys life insurance policies on each of the two partners, uses company money to do that. Now the policies could be designed just like what you showed, what we've been looking at, so that it has lots of cash value, so that the company on their balance sheet, not only are the two owners of the company insured, so if something should happen, they have enough money to buy out the other partner, but also the cash value in the policies, which would become available immediately in the first 30 days, can be used for business operations. We have lots of companies like developers that will put money. I got one right now, they're doing it on all their key employees. So they're like their key persons. Okay, so this person runs this division, this one runs this division, this one runs this division. To the business owners, they look at it and say, if I lose, key person number one, it's going to be really expensive to replace this person. We got to train somebody. We're going to have to probably pay somebody a lot of money and a bonus to get them. So there's an insurable interest for the company. So the company takes out a policy on all their key employees, and the company can fund those policies through company monies. Okay, I wouldn't take the tax deduction, although you can. I wouldn't do it. Consult with your CPA about that, because then the benefits become taxable. So then there's a lot of different ways to structure it, but you would give that key employee a portion of the death benefit, fully paid up, or however you want to structure it, after so many years. If they stay with you for 5 years, they get a fully paid up $100,000 death benefit. You can be completely discretionary in how you do it. So it doesn't fall under ERISA laws. And then the cash value in each of those policies on your key employees can be used to fund business operations. This developer, what they do is they put the money in these policies for these key employees. They then will use the loans from these policies to fund future developments in each of the divisions. So if key employee runs a division for single family home buildings, what that policy will fund is whatever is appropriate for that division. Follow what I'm saying? So in some other businesses, like businesses that need equipment like trucks and trailers and heavy equipment, they'll start policies starting with usually the partners and then the key employees, and they'll use the cash value to finance equipment in their business. I mean, I can't speak to equipment financing, but I can speak to a vehicle. So we own a vehicle with this company. Okay, it's a vehicle we use for a company like me getting back and forth to work. This company fully funds the vehicle. And how do you think the vehicle was funded? A policy. A policy bought the vehicle. The company then makes payments back to the policy for the vehicle. I did it with a copy machine right over here. The company bought a copy machine, makes payments back to the policy for the copy machine. So it can be used lots of different ways.
So Neil was just asking, applied for a HELOC, submitted 2022 taxes, prior years, there's no income other than Social Security, afraid it's going to get denied. Are there any mortgage companies who understand the reason why they're tapping the HELOC?
I don't know. Banks are really tough right now. Banks don't want to lend money. They're making it very difficult to get money. So
yeah, it's really tough. I just talked to someone yesterday. They're going on month 4 of waiting on the bank to approve their HELOC and still nothing.
Even the bank I go through, which is a community bank that I have a deep relationship with, they've funded over 200 deals for me. I've never been late on a payment, never missed a payment. I've been a perfect customer of that bank. They are running me through the gamut for a couple of our rental, which we've been selling off most of our rentals, but we have a couple of rentals that they're just running me through the gamut. We need this, we need that, we need this. We can't lend that much. We can't lend on these terms. Everything's changing in the banking industry. So like I said at the beginning, there is not a more important time in most of our lives, depending on how old you are, that taking back control of your money is more important. Like right now, like the biggest thing I'm trying to do is get as much money into policies. I got policy number 10 that just got approved. I just haven't funded it yet. I want to get as much money into policies so that I can buy out all these mortgages. So when a mortgage comes due with the bank at the low interest rates and is going to reset at 7%, I'm going to be like, thanks, but no thanks. You can shove that mortgage up your ass because I'm going to buy that mortgage. I just did it last week. My bookkeeper and I just sent the check to buy out one of the mortgages. It was about $230,000. So my policies are financing that purchase of that property, which that property was sold and we're holding the mortgage on it. And it's I guess under contract to be sold again. So I will get those interest payments every single month to my policy. And then when the property sells, I'll get all my money back and then I'll pay off another one and another one and another one. And eventually I will owe no bank anything. I will just owe my private banking system all the money. How cool is that? But it just takes, the problem is a lot of people are in such a hurry. It takes time. I've been doing this for, gosh, almost a decade. It takes time, folks. Actually, no, almost a decade now. It just takes time. That's all. It just takes time.
Let's see. When paying off a loan, why doesn't the principal and interest go to the insurance company's account? They are using our cash as collateral. They have to get the funds to loan from somewhere else, and it must be replaced.
I don't really understand that. The thing you have to understand is you're thinking of an insurance company like a bank. Okay.
Yeah.
A bank can't lend money unless you deposit money. An insurance company has, like, just, I don't even need to tell you because you won't believe me, but just pull up any mutually owned insurance company. Pull up One America, Lafayette Life, pull up Mass Mutual. You can look at their balance sheet. They have hundreds of billions of dollars. Like, not a billion, not 2 billion, not a couple billion. They have hundreds of billions. Like, you don't understand the size of these mutually owned insurance companies. And an insurance company does not operate like a bank where they use this fractional reserve banking bullshit. Insurance companies use Austrian economics. And basically what that means is if I promise to pay out $1 in death benefit, I got to have $1. So think about that and just do the math there. Their general accounts have so much money that's why it's not a concern that they do this. This is a money-making proposition for them. They're charging you 5.5% to take your death benefit out. But to us, it doesn't make a difference. I showed you the math. Like, what does it matter if they charge me 5.5% when this year on that policy I mentioned, I made 63%? It's mathematics, folks. It's the one thing I don't know why we can't comprehend, because it truly is just math. There's nothing complicated about this.
Last one. If I own a nonprofit, would you recommend donating a policy to my nonprofit so I can write off the premium and let my nonprofit use the cash value of the policy?
It's actually very interesting because in that particular scenario, the premium deposits could be, if it's properly set up, could be a deduction, because it is. You are funding a premium and you can write that premium off. Consult with your CPA and tax advisors on this. I can't give you tax advice, but I have a foundation. I have a 501c3. And if I were to take some of the money in my foundation and fund a policy, being the insured as the principal of the foundation or the trustee of the foundation or whatever the terminology is. Anyway, I'm confusing trust and foundations. But then when I die, the proceeds from the death benefit go back into the foundation. How cool is that? Plus, while I'm living, the cash value in that policy can be used by the foundation. It could be used to make investments for the foundation, so the foundation has more money to give. Yes, this is done every day. Just follow like everything that you've seen with foundations. The bigger ones, the ones that are more sophisticated, are doing exactly what you just mentioned. That's an awesome, awesome concept.
I'm consulting with a financial planner who requested a copy of my policy prior to our meeting. Any idea on what they might say about it?
Why would you put money into this? This is a terrible place to put money. Just follow what Dave Ramsey says. They're going to tell you they don't, number one, understand the infinite banking concept. So I think I'm saying that right. Ask them when you meet with them. Before I get into this, can you please tell me and define what the infinite banking concept is? And if they say anything other than the true definition of the infinite banking concept, which is the infinite banking concept is the process of taking back the banking functions in your life. But if your financial planner says the infinite banking concept is a whole life policy, wrong. They don't even understand it. They won't know how to do the math. They'll do the math the way that I kind of tricked you guys earlier and did it. You know, they'll run the math and show you the 1.1% and say, why would you ever put money into that? That's stupid, blah, blah, blah. They won't understand it. I wouldn't even waste your time showing it to them. I wouldn't. They won't understand it. They won't take the time to learn it. I don't know why, but they think they know everything. So best of luck to you on that one.
It's funny because if I'm working with a new infinite banking agent and they're kind of new to the industry and understand infinite banking, but they don't understand the mindset of the client. And I talk with I'll meet with one of their clients and I will know that it's a new agent that's helping that client, because that client, all they're doing is asking me a bunch of questions about the policy. Why does the policy, why am I still breaking even in year 10? Why, isn't this thing growing? What is the interest rate of growth on it? Like all of these questions about the policy. And I knew that that's a new agent helping them, because at the end of the day, the policy is the least important part out of all of this. We're using this policy as a warehouse of wealth, as a vehicle that gives us uninterrupted, guaranteed, compounding, tax-free growth for the rest of our lives, no matter what else happens. where he's simply using that as a vehicle to create this system so we can do the infinite banking concept, which is a process of using the policy and keeping that money moving at all times. If you're just looking for a place to put money and have it grow for you without you doing anything at all, this is better than a savings account, but you might be better off buying like an annuity or something like that. If you really just don't really care, you just want to stick it in, and this probably isn't for you. And I always can tell that just listen to the client for 2 seconds, whether that agent actually knows what they're doing or not, because if not, that agent would have already brought the client over and taught them the concept, the process. That's the most important part about all of this. And once that kind of clicks a little bit, all this is going to make a lot more sense.
And we do trainings on this all the time. There's 800 YouTube videos. You can go to Be Your Own Bank or BeYourOwnBanker.com, and you can see case studies and use cases for how this is done. I mean, we're doing nothing but educating. And here's the other thing to the person that was talking about their financial planner or any financial advisor. Like, I'd be happy to get on a call with any financial advisor, any CPA, any financial planner, any of them, under one condition. They must watch the 90-minute video start to finish before I will ever get on the phone with them. Because when I get on the phone with them after they've watched that, if they then can still try to poke holes in it, then we're going to have a good conversation. Outside of that, they're not going to try to understand this. They're just going to talk, and I'm going to get pissed. I'm going to swear, and it's not going to go well. How do I know that? I've tried. It just doesn't work.
Hey, Chris, is the 2025 video out on YouTube?
Yes. Yeah, here, I'll put it in the chat.
Your YouTube page has so many videos.
Well, we do almost one a day.
It really is incredible.
And the video quality, if anyone's been watching them, it's just been so freaking good. Like, I hate bragging about my YouTube channel, but my goodness, like, I watch the videos after we record them. Like, we record every Monday. We record them, and then he sends me the edited ones. And sometimes, like, I'm just like that video you saw today, like, I'm just cracking up down in the kitchen, and my wife's like, "What's so funny?" And I'm like, I'm just watching the new video that Jordan just sent me, and they think I'm absolutely bonkers. They think my wife thinks I'm crazy, and then I'm like, "No, watch this part," and then she starts laughing her ass off too. It's, it brings humor, but like just solid knowledge in. And I don't think anyone will ever understand the amount of energy, the amount of planning, and the amount of money we spend to produce this content so that all of you have this access. I mean, it doesn't cost you a penny to use YouTube. It costs you a click of a button to subscribe to my channel. And then I ask you to click the little bell on the top so that you're notified about the other trainings we do, like this afternoon, the Ask Me Anything happy hour and the What the F's on the morning. And every time I put a new video up, and it's just going to keep getting better and better. I'm going to keep putting more and more money toward it. I just enjoy it. It's the one thing in my week that I think I put above everything else in terms of an enjoyment factor is creating content. I just love it. With that being said, I think we are at the top of the hour, or hour and a half, I should say. So I just put the video up there for the 2025 video. First and best 4D thinking video I've yet seen. Yeah, Todd, it was interesting creating that video. I can't believe it hasn't been taken down, but we put that disclaimer in the beginning because of that. It was really not rehearsed. The only thing we scripted on that was kind of like reverse engineering the timeframes of, like, in 2020 this happened, and just going through, and everything else was me just getting in that. It kind of be like an actor getting into the zone of their character. I just had to get into that character mode, and it just flowed. And the hardest part about that video was the editing. It took almost a month. Literally, it took almost a month to edit that thing. It was hard to edit because, like you said, you're doing it future paced. You're from the future coming back, so you had to do the editing around that. It was so much fun to do, and we'll do more like that. What percentage of your cash value are you comfortable deploying typically? As much as I can. There's always extra cash value in my policies, but I try to find a place for it. Like right now on Private Money Club, here, we'll wrap with this, and then I just want to show you guys something. On Private Money Club, so I'd met an individual at Money Tank, and it's all about just showing up, right, and making connections. Met an individual, we did a little sidebar conversation about his developments and what he's doing. So on here, you can see there's all the deals. So this deal, I clicked on it because I had literally almost 40 grand in my self-directed IRA. So I looked at this, and this is the gentleman I talked to, and he was talking about what he's doing. He's got a $40,000 ask for 12 months or less, which I like short-term deals, 12% paid monthly. I love that, in a first lien position. So right out of the hole, and a promissory note, it checked all the boxes for my criteria. So I think this gentleman was listening when I was talking in Private Money Club, Money Tank, about like what I like, because this just clicks all my boxes. And then I looked at it. This is some of the other houses he's developed. This is the project that I will be funding, which he's showing. He's just kind of giving examples of other projects he's developed from ground up. So I would be funding basically, the rehab or something to that matter, the infrastructure in that for this particular development that he's showing here. So I like that. Now, the only thing I'm doing right now is with D4, one of the options in the Done For You program is going to be an underwriter. So we actually have, and I'm hiring him. It hasn't happened yet, so I don't want to curse it, but very soon I'm looking to hire a guy that runs a bank, a traditional bank, believe it or not, and he's going to be coming on and helping me build out D4 with Tess, and we're going to be building it out, but he's an underwriter. So one of the, the higher end packages with D4 are actually going to be underwriting. So if I got a deal like this, like what, his name's Brandon, will do is he will literally ask, Gunther, the borrower, for the particular things he needs to underwrite it. And he will do, an underwriting like he would for a bank on the deal. And then when he gives me the green light, then I push play and Gunther gets the money. And that's just an added service. It's going to be part of D4. But this is where I found the deal that I'm funding, I don't know, next week and a half or so. So, that's how I'm looking at them. And it just got to find ones that check your boxes. All right, folks. Well, I hope you guys enjoyed this episode of Wealth Webinar. It was fun. It was cool that we got to actually bring it back to that old 2008 policy, just to show you that, you got to be careful who you get your advice from and who you listen to, because everybody else you're talking to is probably telling you whole life is a terrible place to put your money, including your financial planner and financial advisor. So be careful who you take info from, because as Will Rogers says, the biggest problem is not what people don't know. The biggest problem is what they think that they know that just ain't so. We'll see you on Ask Me Anything at 4:30 today. Until then, have a wonderful afternoon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.